One of the most persistent misunderstandings in the uranium market is this. The market can be structurally short without looking tight. Prices can appear stable, headlines can be quiet, nothing looks stressed, and yet the system can already be under pressure. That disconnect matters because many investors still wait for visible signs before concluding that a shortage exists. They expect price spikes or urgency, or some obvious sign that something is broken. Uranium doesn't behave that way. Shortages in this market do not announce themselves through price. They reveal themselves through behavior, and they do so quietly. To explain why, I want to walk through 4 points. Each one describes a different way stress shows up in the uranium system before it becomes visible in prices or headlines. When you put them together, the contradiction disappears. The first point is that uranium shortages show up in contracting before ever showing up in price. The first place behavior changes is not the spot market, it's the long-term contracting. Utilities do not buy uranium reactively. They secure fuel years in advance because reactors cannot stop running. That forces them to act on expectations rather than on headlines or short-term price moves. When utilities become less confident the future supply will be available on acceptable terms, they do not wait for confirmation. They adjust behavior early. They contract sooner. They extend the length of those contracts. They accept less flexibility. None of this requires price to move. From the outside, the market can look calm. Inside the system, utilities are already competing for future coverage. By the time uranium prices are visibly reacting, the shortage has already been recognized by the participants who cannot afford to be late. The second point is that capital senses stress before utilities visibly change contracting behavior. Capital often moves even earlier. If you look at this chart, it shows the percentage change in the uranium spot price since the beginning of 2025, mapped against the average share price performance of 6 North American listed uranium producers. What matters here is the sequencing. For much of that period, the spot price barely moved. Long-term prices had not yet adjusted. Utilities had not visibly re-entered the contracting market. And yet producer equities had already begun to reprice. Capital was not reacting to price. It was reacting to stress. Investors were not buying producers because uranium prices had risen. They were positioning around the scarce part of the system. The producers who control existing supply, permitted assets, and operating leverage that matters when supply is constrained. Capital does not wait for confirmation. It anticipates where constraint will matter and moves towards the assets that benefit when the system tightens. Recognition does not happen all at once. Capital senses stress first, utilities respond next, price moves last. The third point is that stress becomes unavoidable when inventory flexibility disappears. For much of the past decade, inventories allowed the uranium system to function despite persistent underperformance in supply. That period is ending. What matters now is not inventory as a theoretical buffer, but the loss of inventory flexibility. As excess material disappears, utilities lose the ability to manage timing risk. They can no longer defer decisions or rely on secondary sources to bridge gaps. Once that flexibility is gone, utilities are forced back into the contracting market regardless of price or sentiment. Buying shifts from optional to compulsory. This transaction does not arrive with panic. It arrives quietly. And it fundamentally changes how the system behaves. At that point, stress is no longer something you can be postponing. It's built directly into procurement behavior. The fourth point is that price is a lagging signal in a rigid supply system. In many commodity markets, higher prices resolve shortages. They unlock supply. Production responds, balance is restored. Uranium does not work that way. Uranium supply is rigid. Mines cannot scale quickly. Restarts take years, and development timelines do not compress simply because prices rise. Price does not prevent shortages, it acknowledges them. By the time long-term prices move meaningfully, utilities have already adjusted behavior. Contracting pressure is already present. Inventory flexibility has already disappeared. This is why uranium often appears calm right up until it does not. When you step back and connect these 4 points, the pattern becomes clear. Shortages begin with contracting behavior, not price. Capital senses stress before utilities visibly respond. The disappearance of inventory flexibility forces that stress into the open, and price reacts last, after the system is already tightened. This is why the uranium market can remain outwardly calm even as internal stress builds. By the time tightness becomes obvious, recognition has already occurred where it matters most. The core insight is simple. A uranium shortage is not defined by volatility or urgency. It's defined by structural behavior. Calm markets do not mean balanced markets. Stable prices do not mean comfortable systems. For investors, the objective is not to wait for stress to appear. It's to understand why stress can already exist without being visible. That distinction explains why this market is so often surprises people and why reaction consistently follows recognition rather than leading it.